Hello, and thanks for watching everyone. I'm Luke, and for the latest reinsurance news video interview, I'm pleased to welcome Urs Baertschi, Chief Executive Officer of Property and Casualty Reinsurance at Swiss Re. Urs leads Swiss Re's global P&C reinsurance business, overseeing strategy, underwriting, and client engagement for one of the world's largest reinsurance providers. Urs, it's great to see you, and thanks for taking the time to join me today.
Likewise, Luke. Glad to be here.
So, we're now just weeks away from the annual meeting of the reinsurance industry in Monte Carlo, and anticipation is building from the conversations that will set the tone for the rest of the year and into 2026. RVS is always a key milestone in the reinsurance calendar, and this year it comes against the backdrop of a strong 2025 renewal season, with early positioning for the January 2026 renewals already taking shape. The market is still navigating persistent inflation, interest rate shifts, and geopolitical uncertainty, while also adapting to evolving climate risks and shifting demand in both mature and emerging markets. So, Urs, against this backdrop, let's start with a look back at the January, April, and mid-year renewal cycle. What are the key takeaways for Swiss Re?
Look, I would say the market has been operating reasonably efficiently. If you look at the ability to absorb some losses throughout the entire value chain, including very large losses like the LA wildfires, the industry has been able to do that in a resilient way. When you look at the supply and the demand side, there's plenty of capital here to match up with the risks that the industry is facing. And then when you look at the behavior of the various market participants, it is still reasonably disciplined. It is a dynamic and a competitive market, but it's still reasonably disciplined.
Yeah, okay, great. So then let's look ahead to the January 2026 renewals, and assuming all things being normal in terms of large losses, do you expect capacity and pricing trends to hold, soften, or tighten further into next year?
Well, you made a very big assumption that everything is going to stay the same there, and there's still a lot of year left. And I think, the beginning of the conference season is just very, very early, right? And there's so much that can still happen here. And so we'll need to remain dynamic and flexible around what ultimately comes out. So it's a little bit too early to predict that. Having said that, we would generally expect the current environment around the discipline and wordings and structures and so on to remain. And then we'll see where pricing comes out. The market will ultimately price where the risks are trading.
Yeah, good point. Okay, so then let's look beyond the next renewal cycle. What structural changes do you see shaping the reinsurance industry over the next 5 years or so?
Yeah, I think the reinsurance industry is a very important part of the overall insurance industry here. That is a critical element to global economic growth. And so, generally speaking, you could probably assume that the reinsurance industry grows at plus minus GDP growth overall. That growth might be a little bit depressed relative to some prior expectations here. Growth is slowing down a little bit right now in various parts of the world. But overall, the reinsurance industry should continue to grow. The other element in the reinsurance industry in particular is you see further consolidation likely to happen. Already now, the large players generally write a higher percentage of the overall premium volume than 10 years ago. And we would expect that trend to continue. There's also this element of delegated authority here, where some companies give away the pen to others to write business. You see some of that. It tends to be quite cyclical in terms of when it spikes. And right now is one of those times when companies are looking for growth, maybe turning a little bit to that area as well for attention.
Yeah, okay, great. And then, as I mentioned in my intro, there's persistent inflation, shifting interest rates, geopolitical uncertainties. They all remain in focus. So how are these factors influencing your approach to underwriting and capital deployment?
I think none of these factors are new by themselves. Sometimes they're a little bit more elevated than others, and maybe all of them are elevated at the same time. But as an industry, we take this into consideration in our models, in our pricing assumptions, in our strategies. Generally, we are quite resilient in the insurance industry, and we work through these various phases of spikes. If they're a little bit prolonged, they can lead to some adjustments to strategies. But overall, I would say there's minor adoptions. The important part is that they're being proactively addressed in the models that we're using.
And then staying with that resilience, and I suppose there's climate and so-called secondary perils, which are becoming less secondary almost. They continue to influence market dynamics. So how is Swiss Re refining its models to manage these evolving exposures?
Yeah, I think we have learned a lot about this topic in the last probably 5+ years, really, where the prominence of these secondary perils was really becoming much more known, not just in our industry, but in society in general. When you look at the percent of the secondary perils over the last 5 years, they made up 60% of all of the Nat Cat losses. So maybe one of their events is not so big, but in the aggregate, they're not secondary at all. Now, in the models, it's a lot harder to estimate where the losses are going to come from. And one of the factors is actually humans play a big part in these natural catastrophes, where we live, how we expose ourselves, and how we mitigate against these risks. So it's a little bit harder to do that. The models have become better. That generally lag a little bit behind because new data emerges and then is included, but they have actually become a lot better.
Yeah. And as you say, like it is with human behavior and things like that, it does make it challenging with modeling. But yeah, I agree. They have come on from where they are. So with that in mind, do you think the industry is adequately pricing for climate related risks?
So now you said pricing, Luke, which is different from costing, right? So we've been talking about the models, what goes into it. And, at Swiss Re, we have 50 experts who has over 200 proprietary models in the Nat Cat space alone that look after this, right? And so we go very deep into these topics. We update them constantly with new information. And what we're looking to do there is to assess what is an adequate rate for a particular risk in an evolving risk landscape. Then the market talks, and this is where the pricing comes in. And if you have a hardening market, then adequacy goes up. And if you have a softening market, adequacy goes down. It's not just one market. There's a lot of different cycles around this. And what is important about this topic is that as an industry, but also as society, we're aware of these risks. We're paying attention to it. We know they're out there. And in the insurance industry, that we charge an adequate rate for the risks that we're taking on.
Yeah. Great. And I know property often grabs the headline, but casualty has also been in focus recently. So let's turn to casualty reinsurance. How would you describe the market at this time? And is this a growth area for Swiss Re in the current environment?
Casualty is a big topic, Luke. So generally, we think about this including liability, motor, financial lines, and workers' comp. And it's not the same in every geographies either. I think overall, across the globe, we're generally constructive around the topic. We're going into it with open eyes. The two areas that I would highlight, we continues to be very cautious about, are U.S. liability. That includes the motor part of that as well, and U.S. financial lines.
Okay, so then more broadly, where do you see the biggest opportunities for Swiss Re's P&C reinsurance portfolio in the next sort of 12 to 24 months?
We start with the clients and what's important to them. Where do they see a need? Where do they see an opportunity? And then we have an open dialogue of how we can partner around their needs, really. Where we have found a lot of intersection there is around the Nat Cat space, property, the various special lines, structured solutions. This is where we've been quite constructive and been able to grow the needs and the support for our clients as well.
Yeah. Okay. And then sort of to end with the final 2 points, it would be good with it only being 2 weeks today to discuss RVS. So it's fast approaching. What do you expect will be the dominant talking points in Monte Carlo this year?
I think we probably covered a lot of them already today here, Luke. But maybe in addition to that, I suspect there's going to be a lot of talk about what's going on in the world in general. There's a lot of uncertainties and volatilities and changing dynamics, and it could look very differently tomorrow than it does today. So I think that's going to be one of the topics. And the other one is artificial intelligence, Gen AI, agentic AI. This is a big topic for our industry and one that we need to be conscious of and quite frankly, lean into it because it can really be a game changer for our industry as well. And that will come up into the conversations as well.
Okay. And then, so what's one key message you hope clients and partners take away from your conversations at RVS this year?
Yeah, we do this really on a client by client basis, but the overall message from us is around consistency and transparency. We're going to say what we do and we're going to do what we say, and there's not going to be any surprises for our clients.
Yeah, great. Thanks, Urs. Look, thanks again for taking the time. It's been a pleasure speaking with you today. Good luck with your negotiations at RVS and for the rest of the year.
Thank you, Luke. You too.